Well, the rupee is unraveling in real time. India's currency touched an all-time low of 96.96 to the dollar in the month of May and has spent July grinding between 96.20 and 96.90. Never far from that very record. In fact, Wall Street analysts now say that the story now is not whether the rupee falls further, but how fast it gets to 100 per dollar. Three forces are converging: first oil, West Asia tensions, higher crude oil prices, and FII outflows that weighed on sentiment, with back and forth strikes by the US and Iran across West Asia keeping crude volatile. The ceasefire markets priced in earlier this year is freeing. India imports nearly 90% of its crude every year, and that every disruption there is a direct hit on the rupee. Second is capital flows. Foreign investors dumped over $22 billion from Indian assets since late February, which marks also the worst outflow cycle on record. But July has flipped. Foreign investors have bought about $1.5 billion of Indian stocks so far this month. That essentially reverses more than $5 billion in outflows in the month of June. Now, this means that the pressure on the rupee is being driven largely by oil-linked importer demand and broader risk aversion than by any capital flight narrative. Third is RBI's playbook that is now stretched. India's forex reserves fell from $728 billion to roughly $682 billion by end of May. The central bank has even opened foreign currency non-resident or FCNR bank window targeting $40 to $60 billion in NRI inflows by the month of September. But that very facility expires just as oil risk persists. RBI has not shown intent to aggressively defend a particular level, telling markets that it will manage the pace of decline and not stop the rut. With the dollar index near 100 and Hormuz tensions that still remain unresolved, analysts are of the opinion that for the rupee, 97 may not be the floor. And to get a better insight on the factors determining the plunging rupee value against the US dollar, we are being joined by Amit Pabari. He's founder and MD of CR Forex, joining us live from Mumbai. Mr. Pabari, appreciate you joining us on the broadcast. Getting straight to it, it's Wall Street analysts who say that the rupee plunging further is imminent. The question is, will the rupee move further towards 100 per dollar anytime soon?
Good morning. Pleasure is mine. 100 is just a number, but the important point here, what I want to make is that for next couple of months, we are expecting rupee to get weaker.
Right. And that brings me to the second question, that even if we see stability of the foreign capital flows, how vulnerable do you think is the rupee at this point if the Brent crude oil prices remain elevated, given that the tensions especially around the Strait of Hormuz remain unresolved?
At this point of time, we are expecting that the crude oil prices can move towards 100 plus kind of level. There are a couple of reasons for the same. One is the elevated tension at the Strait of Hormuz. Second, if we see globally, the strategic reserves, which most of the countries holding, is at lowest level. So these are the 2 points which will bring the crude oil prices towards 100. Now, as a country which is more dependent on the crude oil prices, any $1 increase in crude oil prices can take our annual current account deficit or trade deficit towards 1.5 or 2 billion. So just imagine the quantum. If we are moving $20 per barrel at the current juncture, what kind of deficit we are going to have. The second reason why we expect rupee to get weaker is interest rate differential between India and US is at not that level where it was there in 2013. So we are expecting debt inflows to be muted. Third reason why we expect rupee to get weaker is because of RBI 100 billion short position. If I have to consider that 100 billion short position, then our FX reserves are as lower as it were in 2022, 2023.
Yes, given the headwinds that persist at this point, Mr. Pabari, in your opinion, what is your outlook as far as rupee is concerned in the near term? say, the next 3 to 4 months for that matter?
For next couple of months, we are expecting rupee to move towards 97.5 to 98 kind of a level. And at this point of time, what we are suggesting to importers is that any dips to be taken as an opportunity to hedge their imports. And for exporters, we are suggesting that they should not be in a rush to increase their hedge ratio. In fact, they can keep a stop loss of 95.5, 95.80 and wait for higher levels close to 97.5 to book their forwards.
Yes. Mr. Pawari, just last question before we let you go. Even if we see the oil prices cooling down for a bit, do you think that oil prices, beg your pardon, the rupee value is going to further decline or increase? That is, if the crude prices do cool down in the near term.
Yeah, let me give you a perspective for that. When the war started, at that point of time, crude was trading at 70 and rupee was trading at 91 kind of a level. Crude moved from 70 to 120, rupee moved from 91 to 96.5 kind of a level. Then crude again came down from 120 to 670, rupee was not getting appreciated. So there are two reasons why rupee did not got appreciated. First, FII outflows were still there. Second, whenever the flows will come, as RBI is sitting at 100 billion of short position, if the crude oil price reverses and if the flow comes in, then RBI will be the first, the team to start accumulating reserves. So appreciation is limited at this point of time, but weakness can persist.
Mr. Pawari, point taken. Appreciate you speaking to us. And of course, still a question mark whether the crude oil prices do cool down in the near term or not. But appreciate you joining us on the broadcast.
Thank you. Pleasure is mine.